Hello there, welcome to the Open on BNN Bloomberg. The TSX closes a record high yesterday. Let's see if it can push further into new territory at the Open. And here are the big stories we're bringing you from the BNN Bloomberg newsroom. Canadian miner Teck Resources posted fourth quarter profit that beat expectations. The company says a surge in copper prices and production were key drivers of the quarter's results. And for the year, Teck has maintained its copper production forecast, estimating output of up to 530,000 tons. Teck is currently in the process of being taken over by Anglo American, and that deal will create one of the world's largest copper producers. Canadian Tire beat profit and revenue expectations in its latest quarter. Revenue rose more than 8%, and same-store sales also saw an increase versus the previous year. The results were driven by strong holiday demand and increased store traffic across the company's major banners. Now, those results come on the heels of the retailer partnering with Microsoft to develop a custom retail intelligence platform. Shares in Molson Coors down in the pre-market after the company posted lower than expected profit, and sales also missed expectations. The company says the sector continues to face significant headwinds as consumers tighten spending and younger generations show less interest in drinking. On top of that, Molson says increased aluminum prices have also taken a toll. The company plans to expand its premium beer brands and scale up its, quote, beyond beer category. U.S. futures actually pointing to a slightly soggy open today, and the S&P 500 still down from its record high close on January 27th. The TSX, though, ended at a record high yesterday. You can see up more than 31% now in the past year. And gold and oil continue to be crucial drivers for our market. I know gold is stuck well below $70, but investors have been buying into those oil sands giants because of their cash flow, reliable cash flow that looks set to last for decades. Speaking of oil, let's check out the latest crude prices. Crude up 2%. The Wall Street Journal, it's either the Journal or the New York Times reporting today that America has assembled the biggest fleet of military aircraft in the Middle East since the 2003 attack on Iraq, America's invasion of Iraq. And of course, the fear and the expectation is that the U.S. will attack Iran. Let's have a look at gold and see how that's trading. Slightly down, but above that 5K benchmark price. Quick look at the Canadian dollar. And it is holding its own against the greenback. And finally, the Bitcoin. Let's see how that's doing. It's been a tough story, tough asset to own, stuck around $65,000 US. The S&P 500 was boosted yesterday by gains in tech, but our guest says that fears over how AI could disrupt entire industries and upend long-standing business models has the market bouncing from one sector to another. This past week, he says, wealth services, real estate firms, insurance brokers, and trucking were all the latest victims of what he calls the AI wrecking ball. We're joined by Craig Bassinger, Chief Market Strategist at Purpose Investments. Thanks very much for joining us.
Thanks for having me.
I love that. A wrecking ball. I think it was a Miley Cyrus song. But you reckon that AI, of course, we don't know, obviously, what impact it'll have, but across industries, we're seeing these fears spread?
Yeah, from our perspective, we do think it's an overreaction in the short term. And, there's no question that AI productivity gains, especially when it comes to coding, is pretty incredible. But trying to extrapolate like those kind of gains into all these other industries, I think is a bit more challenging. But the narrative has taken hold in this market, and as soon as any headline comes out that AI is going to have an influence on any given industry, the market's just running out and selling down the names, questioning the longevity of their business models.
You supply an interesting example here. The trucking industry, a Florida company called Algorithm Holdings, said its service has improved freight volumes radically for its clients. And you say that contributed to a sell-off in trucking stocks?
Yeah, and this company, listen, I mean, maybe they're doing some great things, so I'm not going to dig that deep into it, but it wasn't that long ago that they were selling karaoke machines, and even in the more recent quarters, their revenue was pretty minimal. I think it just sort of highlights that, and maybe they do have something great, but I think what it does is it highlights just how sensitive this market's become, and that's really kind of been one of the themes this year. Like if you the markets are fine. If you look at the S&P, it's pretty close to its all-time high, same with TSX, but the gyrations under the hood have just become, I would say, a bit unnerving, whether it's AI, whether it's, gold going up 1,000, down 1,000. Like, we're just seeing some really material moves that I think is sort of characteristic of a market that is probably more fragile than it appears on the headline number.
The market is the broad market is more fragile, you mean?
Yeah, and just investor sentiment. Selling off $70 billion worth of trucking stocks because AI is going to help. It just seems like a dramatic overreaction. And I don't. I think the productivity gains and the use cases on the AI side are phenomenal. We're using it quite a bit, but I would also say the market, historically, markets very much overreact in the short term and underreact in the really, really long term. And I think right now we're probably in a bit of that overreaction on the short term tenor.
Insurance brokers, I guess, yeah, if I'm shopping for a policy, AI might make it easier to compare what's out there. I wouldn't want to trust it, absolutely, but it could give me some useful leads.
Yeah, but like there's already websites that do that. So it is interesting how people are sort of like extrapolating that, I'm not going to need a real estate agent anymore, or somehow trucking is going to, solve all the logistics problems, which, let me tell you, I mean, they've been using machine learning and other AI type tools in trucking forever to try and sort of better optimize routes and loads. So I just think it's sort of the mentality of the market, and people are rushing around, and I think a lot of fast money is rushing around to either short or exit and that type of thing. And I think that's creating some of these pockets of volatility. Right.
We're showing Mullen Group, not necessarily caught up in the selling because of this algorithm name, but it's an example of a prominent Canadian trucking stock. Real estate, what is the fear there about disruption from AI?
Well, that's like, everybody's just sort of guessing what it could actually mean. But on the real estate side, it's quickly that, is it going to help me actually find a house and close deals and do paperwork and take care of all of that, which normally you would sort of pay a pretty hefty fee to somebody else to do. I think a better trucking example would be Transforce. Mullen's a good trucking company, but certainly more focused on the energy space. So might be some other factors at play there. But yeah, and listen, I mean, Shopify keeps, oscillating in these huge moves up and down, and people are just, fearful that, are people going to online shop differently going forward? And so I guess what I'm getting at is this market's overreacting, I think, for sure in the short term in a lot of these names, and possibly creating some opportunities. We actually purchased Transforce a few days ago on the weakness on the trucking side late last week. I think the market's overreacting in certain pockets, and that's possibly creating some opportunities. That being said, I would also caution, on the cautionary side, like, we've just had 3 great years in the markets, and don't get me wrong, we could have a fourth. The economy is decent. There's a lot of good things going on right now, but 4 years is getting up there, and so one of our themes, while we do see some pockets of opportunities, a bit more on the international side, a bit little pockets here and there, we certainly have a bit more of a tilt of protect what you got after 3 outsized gains, 3 years of outsized gains.
You still are interested in international developed and emerging markets. Tell us, I know that's a very broad category, but tell us what your thinking is there.
Yeah, we were it's funny. I think everybody's sort of have jumped on this bandwagon now. We had a pretty big overweight, and this is in our multi-asset strategies. We had a pretty big overweight, a few years ago, and last year it worked out exceptionally well and helped drive a lot of the relative performance for our strategy. But last year I think it was. You look at international markets and they're always typically cheap, like the valuation discount's pretty big against the US, but it's a bit of apples and oranges. I think what changed last year and what really drove international markets was you had this sort of broadening of earnings growth where previous years it was just the S&P was growing decently, TSX, Europe, Japan they were growing, but just much lower growth rates. And the earnings growth went more global, and that's essentially what drove a lot of the performance last year. And as we roll into this year, it's pretty positive as well. I mean, the earnings growth is continuing. There's still a pretty good valuation discount. And what we like to say is a lot of these markets are what we're going to call fixer-uppers. Like they're actually starting to turn on a bit more fiscal spending that's market friendly on infrastructure and defense. They're starting to change regulations, especially in Japan, where they're starting to sort of show where things are, they're cracking, or they're trying to discourage cross ownership of companies and be more shareholder friendly. And these have pretty big lasting impacts on valuations and the way the market behaves. And I think those are some of the positives. And I would highlight, Japan's been the star so far this year. I think it's up 13-14% year to date, and certainly leading the way.
Maybe we could put up a one-year chart for TLT, which is, as you know, an ETF that tracks U.S. bonds, longer-term bonds, or maybe just a one-year chart for the U.S. 10-year bond yield. Investors have been swinging into bonds lately. Is that simply because a lot of money's been coming out of tech and looking for a home?
Recently, really recently, or over the last number of quarters?
No, over the past week or so.
Oh, okay. Yeah. So I think there's a bit of a risk-off appetite where people are putting money into fixed income a little bit more. I wouldn't use the TLT for anything like that. That once you go that far out on bond duration, I think you're just playing with a different kind of almost a different kind of animal at that point. But yeah, there has been a bit of a risk-off appetite, and I think some of it is money coming out of tech, money moving into defensives, and this includes bonds, it includes defensive equities, it includes even some of the cyclicals. Like money's just, I think, coming a little bit out of tech and going to other places. And I would point out if you break the market down so far this year, it's been cyclicals and defensives that have been leading. That have been moving higher, where tech has been moving lower. That's obviously very different than previous years. And I think it's those defensives and cyclicals that are probably helping the headline number hold it up a fair bit better. But I would also say that's kind of weird. Economically cyclicals and defensives usually they don't usually travel together. So the fact that both of them are going up, I think, is just another sign that this market is a little bit squirrely, and there's some things going on underneath the hood that are, should have people at least leaning a little bit more on the defensive side. And
just on that theme, you say the swings in precious metals. I mean, silver went shooting up, then came down, or Bitcoin collapsing by about 50%. You say that points to a jumpy market anyway.
Yeah, I mean, I would say on the Bitcoin side, it's halved, and it's not one of its official halvings.
No.
So this one's price related. I would point out that I think Bitcoin is still a bit of the tip of the spear on the risk appetite in the marketplace, and so it coming down is also endemic of a market that's just cooling on risk appetite. I think the sell-off in software. I mean, you can explain other reasons for these kind of drops, but I think that sort of all feeds into it. And then on the gold and silver side, listen, gold, we like gold. We still own bullion. We have reduced a little bit last year, but I would point out that when gold goes up $1,000 in a week and comes back down 1,000 in a day, that's not healthy. I would also point out that we historically we own gold for sort of what we call crisis alpha. Like if everything starts to break down, gold usually kind of rises to the rescue. I don't think that's what gold is anymore. This is now a momentum trade. Now, that doesn't mean it's going to go down. That means it actually could keep going up. But I think it's detached a fair bit from fundamentals. So I think right now it's certainly delivering alpha from our perspective, but it is no longer a defensive diversifier at this point.
Thank you very much indeed, Craig. Craig Bassinger, Chief Market Strategist at Purpose Investments. Up next, the Airbus CEO is mad at Pratt & Whitney for not delivering enough engines. And he says production at the giant aircraft maker will have to be lowered. We'll have more after this. Airbus says it's going to have to cut back on its ambitious production goals for the A320 aircraft. And that, it says, is because a key supplier, Pratt & Whitney, can't get it enough engines. We got perspective from the Airbus CEO, Guillaume Faury.
Indeed, it's a quite frustrating situation to be in. We were expecting a much higher level of deliveries for 2026, and we have to guide to 870, which is still 77 aircraft more than what we delivered in 2025. But it would have started with a 9 because we have the ramp-up ongoing on all programs. And we have the potential to do much more than these 870, but we need engines. And what we received from Pratt as an outlook for 2026 is significantly behind their previous commitments, the orders that had been accepted by Pratt for the GTF engines. And therefore, we have to look at things as they are, at least for the moment. So significantly behind what we would have done.
Okay. So let's call it 30 aeroplanes that you are not going to be delivering in 2026 as a result of that issue. How much money, therefore, are you losing on those 30 aeroplanes? Can you quantify that number for me?
I will not be specific on this. We provide a guidance that is on the number of aircraft that is with an EBIT adjusted of around 7.5 billion and a free cash flow of 4.5. But there is a very substantial gap between what we would have made in terms of free cash flow and EBIT would we have those aircraft compared to what we have. Even more, as we have to deal with inventories as a result of that situation, because the rest of the supply chain is moving forward. We have already a lot of those aircraft in the production pipeline, and we will have to adapt our production and decide what we do moving forward in the year. But it will create, obviously, a headwind, a charge for the inventory and therefore for the free cash flow.
Are you going to seek compensation? I imagine you are from Pratt & Whitney as a result of that. You say you started the process to enforce contractual rights with Pratt. Can you tell me exactly what that means, what compensation looks like, when you could obtain that compensation, when your shareholders will see the benefit of that?
Well, we have a contract with Pratt & Whitney, and we are enforcing the contractual rights we have. So we have initiated a dispute with Pratt & Whitney. We don't intend to report on the steps that we are making with them and on the puts and takes of the negotiation, but we are indeed pursuing enforcement of our contractual rights. We want compensation for the missing number of engines compared to the orders that had been accepted, and compared to what the damages that will be made to Airbus. So we are in this process.
Okay, I just want to turn to another issue which currently Airbus is involved with, and that is the next generation fighters that Europe is looking to build. You are currently in partnership with Dassault on the FCAS program, the Future Combat Aircraft System. Guillaume, everybody thinks that program is now dead. Is that assumption correct?
I like to say we are wrong to be right too early. It's just to share with you the fact that we're in a difficult place, moving from phase 1B to phase 2 on one pillar of the future combat air system, which has a lot of pillars. The pillar is the so-called next generation fighter, where we are contracted by Germany and Spain for a cooperation with France, where Dassault is the industrial partner that has been selected by France. And the transition from phase 1B to phase 2 is currently a matter of a lot of negotiation on the governance and also on the way the product that would be manufactured jointly would respond to the requirements of the different contracting bodies, meaning the government. So this is now a matter that is between governments to decide how we move forward. We're responding as good as we can on the requirements, but I don't want to comment more on what will be the way forward.
The Airbus CEO speaking to our Bloomberg partners. Up next, we'll check out some stocks that are expected to move at the open. Let's check out some stocks of interest as we await the opening. And there you have it. U.S. stocks down. Of course, there are jitters over the potential of U.S. attacks on Iran causing geopolitical disruption. Interesting. The British have blocked U.S. President Donald Trump from using RAF bases for strikes on the Iranian regime. And apparently, President Trump is not happy, and as you might expect, and has withdrawn his support for Britain's deal to hand over the Chagos Islands, to Mauritius. Interesting, though, the Brits not backing Trump on those attacks, apparently. Let's have a look at Avis Budget. That stock down, car rental company, forecast adjusted EBITDA for 2026 that missed estimates. Carvana, the used car giant, plunging 11% as rising costs hit margins. Analysts pointed to weak retail gross profit per unit. And interesting that we should see that at a time when the U.S. economy is still ticking over pretty well. I mean, there are signs of cracks in the job market, but obviously used cars are pretty important. A pretty important indicator. And one factor helping to casting a shadow over U.S. stocks right now, Walmart offering a fairly cautious profit forecast, citing in part worries over getting productive labor. Opening bells are next. There you have it, the opening bells on Wall Street and Bay Street. Looks like it's snowing in Toronto there. At the NASDAQ, Major League Baseball is ringing the bell, teaming up with PepsiCo to do that. At the NYSE, Centrus Energy is celebrating what's being billed as a multi-billion-dollar expansion of its uranium enrichment plant in Ohio. Because that's interesting, because America doesn't have enough enriched nuclear fuel. And at the TSX, First Trust Portfolios Canada, this is the hot topic right now, celebrating the launch of the First Trust Bloomberg Nuclear Power ETF. It is time for the first 15. Now let's check in on the equity markets and let's see if Toronto's, slipping from yesterday's record high close. We're also seeing some weakness in U.S. stocks as we begin this Thursday's trading. Walmart coming out with a cautious outlook, saying that labor tightness is one of the problems that it faces. Let's have a look at some stocks of interest here. Tech Resources. Now, in a way, their report is moot because they are being swallowed, or in the process of being swallowed by Anglo American. Jefferies reckons that fourth quarter results were solid. Earnings and free cash flow beat. There were lower than expected operating expenses and capex. I'm just wondering why the stock will be down, and I'm guessing it has to do with weakness in copper. Let me just have a quick look. And copper is down about 10 cents, but not too bad. But anyway, tech selling off right now. And let's have a look at Canadian Tire. It looks like they had a pretty good quarter, and the stock jumping about 5%. Strong comparative sales across all of their banners, and also gross margin expansion. Mark's Work Warehouse, that's where I got a balaclava that was like something you'd wear on the oil sands, and it's one of my most precious possessions in bad weather. Let's have a look at MTY, the food court empire. And you can see that stock up as well. Of course, it got hammered in the pandemic when people were eating at home. They weren't going into the office. Normalized adjusted EBITDA at MTY beating estimates. However, US and international sales are soft, apparently. And here's the stock, a new stock for us anyway, Mkango Resources. Now, it's not a huge company. We're showing it down about 3 cents. It's Canadian listed, also trades in London, I believe, but it's focused on rare earths in Malawi and Poland, and it is planning to list on the NASDAQ. So we'll keep an eye out there. Let me just check what the market cap of this company is. Oh, I don't have that right now, but there's a lot of interest, of course, in rare earths, but the real trick there is processing the darn things, not just producing them. Market cap, my screen shows, of about $360 million. Let's check out some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities Team. Thank you very much indeed for joining us. Jeff, EPAM Systems down. What do they do? Can you remind us?
Yes, EPAM Systems is an IT services company, and they are getting hammered so far this morning. The stock has been the worst performer in the S&P 500, and by a fair margin. This stock was down 17% in the pre-market session, worth watching over the course of the day, just given the size of the decline here. What happened? They came out with a revenue growth forecast overnight, which was well below what Wall Street had expected from them. The company now sees 3 to 6% revenue growth over the course of the year. Wall Street wanted 6.3%. So, even the top end of their expected revenue growth is below what Wall Street wanted, and the bottom end is well below. TD Cowen was out with a note this morning that said it's hard to tell how much of this is prudence and how much of this may be a change in expectations or a change in a change in conditions. Worth watching over the course of the day. Yikes, 21% in the regular trading session so far. Big drop. That is the worst performing stock in the S&P 500 so far right now.
Carvana, the used car giant, hitting some rough sailing?
Yeah, rough sailing, that's right. Pothole, I guess, for Carvana.
Better, yeah.
EBITDA missed. This is that's right. Maybe they'll get into boats someday. They'll have to change the name. But so big miss here on the EBITDA. What's happening? A couple things. One, as you had mentioned a little bit earlier, used car prices, they're not seeing as robust profit margins on this. And that is hurting the sales and the profits for this company. But also, they are seeing larger depreciation on the cars that they have in inventory. This is a fast-growing company. They have been acquiring a lot of cars to expand their network. They've also just been spending money to expand, while at the same time, the cars that they have in their inventory have depreciated more quickly than they previously expected. You add those two things together, or those three things together, lower profit margins on each car, depreciating cars that they have in inventory, and a lot of money spent to grow, and you have a company that now is missing EBITDA expectations for the quarter. Big miss here for Carvana. 6.3% is a big move down, but it's not the worst performer in the S&P 500, thanks to the giant drop from EPAM Systems.
And conditions are getting better for farmers, and that's good news for Deere.
Yeah, Deere. So we have, for a few years, been in this kind of negative cycle for agriculture, and this has weighed on not only Deere but other agriculture equipment makers and just agriculture firms in general, including in the fertilizer space. Deere this morning, they're not exactly ringing the bells, but they are saying that things look like they're starting to look up. The CEO came out this morning and said that the 2026 year looks like it could be the bottom in the current cycle. They raised their profit forecast for the year as a result, and so the shares are getting a nice lift this morning. Again, this is a company and this is a sector where there had been a lot of negative sentiment. It has been kind of mired in a long kind of bearish turn for a few years now, and we may be seeing the uptick here as a result of a improved profit guidance from Deere this morning.
Jeff, thanks very much indeed. Jeff Morgan of Bloomberg. Up next, it's a dramatic pivot by the man once nicknamed Dr. Doom, Nouriel Roubini, who spent years warning of stagflation and slowdown, has now turned bullish. The man sometimes billed as Dr. Doom has apparently shifted to Dr. Boom. Nouriel Roubini is an economist and chairman, and CEO of Roubini Macro Associates. He thinks that the US is set for steady economic growth in the next few years. We got perspective in an interview with our Bloomberg partners. They began by asking him what's behind his shift in tone.
Well, I've been arguing for over a year that there's a productivity growth acceleration because of technology of the future. Everybody's obsessed about Gen AI, but there's also semiconductors, robotic, automation, quantum, fusion, defense tech, fintech, new material science, space exploration, biomedical research, and so on and so on. They're all related to AI, but they're all separate, essentially, silos and verticals, and each one of them, thanks to AI, there's going to be a significant boom. US is ahead in most of them, China is ahead in some of them. So it's a game between US and China. That's why I've been saying that potential growth in the US is already well above 2%, and by the end of the decade, it's going to be closer to 4%. I'm quite convinced of that. When I say to economists, they say you're crazy, 4% growth. But when I speak to technologists, they tell me you're still Dr. Doom because 4% is too low. It's going to be higher than that. But I think it will be close to 4.
Let's say you're right. How does that change the outlook for interest rates, if at all?
Well, you know, Kevin Walsh argues, like some others, that implies that because we're going to have lower inflation, that justifies lower Fed funds rate. I think is incorrect. Because if potential growth is higher, the equilibrium real long rate and also the real short rate, Fed funds rate has to be higher because there's a correlation between real growth potential and real interest rate. It's true that then inflation will be lower than 2%, maybe closer to 0. But today, say, you have a Fed funds rate where most of it is inflation and 1.5 of it is maybe the real rate. But once you have a growth of 3-4%, the equilibrium real rate has to be at least 3%. Maybe inflation is 1, and then you get still at a 4% nominal. So having a lower inflation doesn't justify lower Fed funds rate if growth is higher, and growth is going to be higher. I think there's a fallacy in that argument.
Well, he might deliver it either way. And if that's the case, if there is a bias to cut at this FOMC in the face of what you're predicting, do we face a real risk of overheating?
Oh, yes, but I'm not sure he's going to be able to deliver it. You know, in the Fed system, the Fed chair is a primus inter partes, is a constitutional monarch, is not an absolute monarch. One vote, and he has to convince the rest of the FOMC to go along. And if the economy is strong as it is, and is accelerating, if inflation is still well above, target, and if it's not going to fall very much, it'll be hard even to justify one rate cut this year, let alone 2 of them. So he cannot really bully the committee. He could end up into a minority and be outvoted. So I'm not sure. And the data so far don't justify having lower Fed funds rates. Maybe one cut later this year in the second half if gradually inflation is going to be slightly lower. But growth is going to be very strong this year, much stronger than last year. I mean, Q3 growth was 4.3%. The last estimate of Q4 is 3.7%. So we don't even have that growth, recession that everybody was predicted. There's actually growth acceleration. And this year is going to be even stronger because you have the tailwinds from AI continuing. You have easy financial condition, stock market and other indices are all-time high. You have the monetary easing in the pipeline, and you have fiscal stimulus because all the spending cuts were pushed until after the midterm election. So you have strong forces going to lead to an acceleration of the economy, not a slowdown of the economy.
I remember once upon a time, I knew someone whose name was Dr. Doom, and he talked about fiscal deficits. He talked about the breakdown of world order. He talked about inflation. He talked about a shift away from the financialization of a world where suddenly you couldn't get these returns. What happened to him?
You know, I wrote this book, Mega Threats, in 2022, when I said that lots of trends are going to lead to lower growth and higher inflation. And that's exactly what happened. There were a whole bunch of factors, but there are also chapters on AI in which I said, if things that look like may happen, but it hadn't happened yet, because at that time in October 22, ChatGPT was not out yet. The proof that you could do fusion energy was not there. The improvements in quantum were not there. All those things happened. They were already in the book, and I said, if those things are going to happen, there'll be an acceleration of growth, reduction in inflation, and therefore we'll be in the utopian equilibrium as opposed to dystopian. And what was speculative at that time has materialized as being real since then. So since it happened, and I was writing about it, now I'm believing that actually tech optimism, that, as I said, tech trumps tariffs, because tech is first order, 200 basis points increase in potential growth, and everything else that is, how to say, stagflationary, that is not just tariff reduction in migration, fiscal deficit, fiddling with independence of the Fed, fiddling with the rule of law, all the other things are second order. So I said tech trumps tariff, but also tech trumps temper tantrums too, because all those things are second order, and market discipline has forced him last year, as I exactly predicted in April, to back down. When the market was down, he was forced to do deals on trade that pushed the tariff rate from 30% to 14% and falling every day.
So Dr. Boom, the sort of gap between dystopian and utopian, pretty wide. And I'm just wondering what happened to some of the political aspects of this, especially as it relates to jobs. I mean, if there is significant job loss, won't the political backlash be somewhat significant? I mean, how do you sort of dismiss the dystopian chapters in your book?
Well, I do believe that eventually we're going to get a permanent technological unemployment, but it's going to be a bit of a inverted kind of a J-curve. Initially, actually, demand for labor is going to increase because you have to build all these data centers. There'll be an investment boom, and not just in AI, across the economy. And therefore, demand for labor is going to increase. We're already at full employment. So for a few years, we're going to be actually okay. Of course, people are out of college. Those first-time jobs are in short supply and this and that. And that's becoming an issue. Longer term, absolutely. I think that by the end of this decade, growth is 4%. By 2040, 6%. By 2050, with AGI, we're at 10%. But when growth is 10%, then unemployment is going to be 80%. But it's better to be in a world where growth is 10%, unemployment is 80%, and with growth doubling every 5 years, you can redistribute, because you can tax the winners and redistribute.
In 2 minutes before the end of the show. I mean, we don't have enough time.
I tell you, that's my bet. We'll get to AGI, we'll get to SAI, and there'll be exponential growth.
Not for me to disagree. That's your forecast.
So that's my.
Let's say you're right. So, how does the government respond in that scenario?
Listen, we're already in a mean-tested UBI system. You know, I live in New York City. My marginal tax rate between federal, state, and local is 54. In Mandarin, might be 57. I pay real estate taxes. I pay also sales taxes. And all this progressive tax system is redistributing income to those who are rightly so left behind. Medicare, Medicaid, Social Security, unemployment benefit, disability, food stamps. So we're already in UBI de facto. We'll have to make it bigger. So in a world in which 10% of the people get most of the income and the wealth, you're going to tax them more, and you're going to redistribute to everybody else for two reasons. Reason number one, if you don't do it, there is a revolution, as long as there is democracy. Reason number two, if you don't do it, there's not enough aggregate demand. A rich person cannot eat more than 3 times a day. You cannot eat 100 times. So you need enough aggregate demand. And Marx was right. Capitalism is going to destroy itself from within, because of underconsumption, if the share of labor shrinks, the share of capital increases. The only way to prevent it is to redistribute from the winners to the losers. So we're already in a mean-tested UBI. We're going to make it bigger. That's what's going to happen over the next few decades. That's going to be the political solution to massive permanent unemployment. It'll be socially disruptive, but the alternative is a revolution.
Oh, those economists on the one hand, on the other. Nouriel Roubini talking to our Bloomberg partners. Let's have a quick look at a gold stock that's under pressure right now. It's B2 Gold. They have a big mine in Canada's north, but also very exposed to Mali. Investors not loving the latest results from the company. I haven't had time really to drill into them, but the stock down about 11%. Right now, I'm just looking at TD's take on it, but gold production jumped, 60% year over year in the latest quarter. But adjusted basic EPS was only 11 cents, and that missed the 19-cent estimate. And TD says the ramp up of that giant Goose mine in Canada has been slower, featuring it's got challenges. And also, people are awaiting a crucial permit at the huge Fekola mine in Mali. And that apparently is discomforting some investors. Up next, Mark Carney is closer to securing a majority government after yet another Conservative MP crossed the floor. That's ahead. Mark Carney's government is one step closer to securing a majority in Parliament after Conservative MP Matt Genereux crossed the floor to join the Liberals. Let's get more from Jeremy Sharon. Jeremy, it's happened again. Pierre Poilievre, the Tory leader, has lost another MP.
Yeah, exactly, Andy. Here we are again talking about a floor crosser. This one's really interesting because Matt Genereux had been rumored to cross the floor shortly after Chris d'Entremont did, the first Conservative to do so back in November. There was a lot of talk about Matt Genereux potentially being another to cross the floor, enough that he put a statement out online confirming that he would not be crossing the floor, but rather that he would be leaving politics altogether. That was announced again shortly after Chris d'Entremont crossed the floor in November. Time has passed since then. He was expected to leave his seat at some point early this year. And then yesterday we find out, Andy, that in fact he will not be leaving politics, that rather he is going to be crossing the floor, as was suspected and had been rumored last year, to join Prime Minister Mark Carney in the Liberal government. He stated in that statement that he posted yesterday that mostly he was inspired by the Prime Minister's speech in Davos, and that he felt the need to stay on or remain in politics and to join the Liberal Party to support Mr. Carney. And so, to your point early on here, the Liberals are now one step closer to a majority in the House of Commons.
How far are they from an actual majority?
Well, they're actually, quite close at this point. When you look at the numbers, because the numbers are so important right now in the House of Commons, 169 seats is what the Liberals have right now. 141 is what the Conservatives have. The Conservatives have, the Bloc have 22, the NDP have 7, and the Green Party have 1. There are 3 vacancies currently in the House of Commons. 172 is the magic number. So the Liberals have 169 seats. 172 is the magic number. They're 3 shy, and there are 3 vacancies. That means 3 by-elections. 2 of them are widely considered, Liberal strongholds. That is Chrystia Freeland's seat. She has left politics to take an advisory role, an economic advisory role in Ukraine. And Bill Blair has left his seat to become the High Commissioner of the United Kingdom. And so, through those 2 seats, the Liberals have a strong chance of, regaining a Liberal MP. And then the third one is Terrebonne, which the Supreme Court just recently annulled the result of that election. The Liberals had won it by 1 seat in the federal election. And so that means there are 3 by-elections to come. They haven't been announced yet, but 3 by-elections to come. If the Liberals are able to hold on to all 3 of those seats, they're able to get a majority government. So 2 of them, again, I think many expect they'll be able to hold on to. Terrebonne is going to be the wild card here because that is historically a Bloc Québécois stronghold, and especially given the Liberals won it by literally 1 seat in the federal election, it is certainly not a locked seat. So that means if they lose that one, they'd still need 1 more floor crosser. All that to say, Andy, they are very much, within reach of a majority. A few different combinations could result in them being able to achieve it.
Jeremy, thank you very much indeed. CTV's Jeremy Sharon. Up next, we'll check out some stocks on the move in early trading. Let's check out some stocks on the move. We'll start off, though, with the TSX slipping from yesterday's record high. First off, Canadian Tire. Investors like the look of those latest results. Strong sales across its brands. Cenovus higher. Chris McCulloch of Desjardins says his first take on Q4, unstoppable. Cenovus continues gathering steam with a massive beat. And let's have a look at First Majestic. There it is, up 7%. It's a sweet time to be producing a silver. Some stocks under pressure. Bausch Health, we've seen some selling there. B2 Gold, already mentioned that. It looks like investors disturbed by the slowness in the glitches at ramping up that big Goose mine in northern Canada, and Taseko Mines seeing some selling as well. Let's check out a few of these software stocks that are still getting no love from investors. CGI, seen as a safe bet because they got that lock on providing IT services to governments and corporations, hitting a new multi-year low, or at least its lowest in at least 1 year, I should say. We've also got Enghouse, another software company, under pressure. Hitting its lowest, looks like a multi-year low there. And Docebo as well. It helps train customers. Stock up a little bit, hitting its lowest in at least a year earlier today. Coming up, more on that Canadian Tire beat. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Canada recorded a trade deficit in 2025 of $31.3 billion. And that is the widest annual shortfall on record, excluding the pandemic. Data from StatsCan indicates that annual exports saw a decline, but exports of gold, silver, and platinum jumped nearly 42%, driven by a run-up in metal prices. Meanwhile, exports to the U.S. fell 5.8%. StatsCan says that for December, U.S. goods exports to Canada were at the lowest since January of 2022. And there's a look at shares in Teck Resources. The Canadian mining company posted revenue in its latest quarter that disappointed some investors, and the capex outlook was higher than expected. Teck's zinc production came in below consensus. However, there was a surge in profit because of higher copper prices. And Teck is sticking with its copper production outlook, estimating output of up to 530,000 tons. Shares in Molson Coors down after the company posted lower than expected profit and sales in the fourth quarter. Molson says the beer sector continues to face significant headwinds as consumers tighten spending and younger generations show less interest in drinking. Meanwhile, aluminum prices have also taken a toll. The company says it plans to expand its premium beer brands. And the TSX in record territory again, very narrowly, a fraction of 1%. It is higher, though, and investors will take that up more than 30% in the past year, when you even if you exclude dividends. And let's have a look at the U.S. markets, and they are showing signs of softness. Canadian stocks at a new record high today, and here's an archetypal Canadian company, Canadian Tire. That company posting better than expected revenue, sales driven by strong demand during the holidays. We're joined by Dan Rahinton portfolio manager at IA Global Asset Management. Dan, thanks very much indeed for joining us. So the company strength across the board, it seems, all of its major chains.
Yeah, and we can say it's a little bit stronger at Mark's Work Warehouse, where you get your steel-toed boots, and also more so for Sports Check than it is for the core Canadian Tire stores itself, which was a beat versus expectations, but far less so compared to the other banners that they do have. And I think the other thing, Andy, was that losses and write-offs on the credit card, the Canadian Tire financial services business was broadly speaking okay as well. So I think it's just all those factors together. And let's not forget that we're talking about a company that's trading at 12 times earnings before the move this morning. So the valuation was more constructive for these types of pretty strong results overall. So it's bringing all those things together that led to the price performance we see today.
I guess bitter winter weather is good for Canadian Tire. It's got us scrambling for boots and stuff like that.
Yeah, it's think of it as general merchandise, right? With an auto parts section and then other banners. So having that type of cyclical dynamic, like a really cold winter, definitely does play a role. But it is worth saying that over time, and I know we're going to talk about Walmart in a little bit, but the best way to think about Canadian Tire is it's that general merchandise player that is seeing some pressure at the margin from more Walmarts, more Costco's opening up across Canada. So there is a competitor that does have scale purchasing power, along with Amazon, which maybe gets too much credit for the Canadian e-commerce penetration it has. Not that it hasn't been successful, but the real story of Canadian retail is definitely Walmart and Costco continuing to expand, and then Amazon following them as well.
What would you be a buyer of Canadian Tire? Maybe you'll put up a 10-year chart for Canadian Tire. Would you be a buyer of the stock with new money right now, Dan?
Yeah, I think it's a tough one, Andy, because I'd say in the context of gold prices and gold equities that have been really robust, financial services that have been really robust, I'd be okay with nibbling away. But I think it's important to just take a step back and say in a closed pond like that Canada is, I would say, yes, it might be worth the time. But looking out globally, I think there's more interesting opportunities than averaging into Canadian Tire, including in retail.
Okay, let's swing to Walmart. The company's guidance cautious. Investors weren't thrilled.
Yeah, the best way to think about Walmart is it's several factors at once. The first one is the e-commerce strategy and basically the copying what Amazon has already proven out to be successful. So basically a last mile retail strategy, adding on advertising as a profit driver. We used to call that, or Canadian Tire would call that trade spend, where you basically, the old saying was you basically pay more to be eye level with the consumer as they're walking down the aisle. That's true in the digital world as well. It just shows up through the advertising dollars. So strong advertising business, decent retail sales, and they continue to basically see what's I think is the most interesting story out of Walmart's quarter is they're seeing market share growth amongst greater than 100,000 income consumers. So they're actually benefiting from trade down as consumers in a higher inflation environment are searching for value and they're finding it through Walmart. I think I will say one thing, Andy, maybe just take to end this long ramble of mine, is at 45 times earnings for mid-single digit revenue growth, inclusive of everything I just said, and EPS growth that's slightly over double digits, it's a pretty rich multiple. So I definitely think that Walmart has benefited significantly from the rotation that we've seen under the hood in the U.S. stock market to start the year, where technology has seen tons of pressure and investors have been hiding in companies where you can't get disrupted by AI, and Walmart has been anointed as one of the primary winners there. So at 45 times earnings, I am exceptionally cautious about where Walmart can go from here.
It's interesting. I mean, the stock is trading near record highs, and it is up today as well. It got to a record last week. So certainly investors like what they're doing in e-commerce, etc.
Exactly. And it's a good, safe place. It's a safe harbor to hide in until there's more certainty around software companies and big cloud computing companies. So there's only a few places like Walmart and Costco that you can go to put real dollars to work. And that is what large pools of capital have been doing to start the year.
It's interesting. They are, for such a huge company, they're an elephant that can dance. They now offer pre-owned Prada bags and also Fender guitars. I think that's in their online channel. So they are willing to adapt.
They're taking the everything store model that Amazon had and cultivated and grew to the scale that it did today. And then they effectively played that forward and are copying Amazon. So right now in revenue, Amazon is a little bit bigger, but if you take out cloud computing, Walmart is still the big dog in the room. But that race is narrowing. So think of the US retail and general merchandise retail market across many parts of the world, but especially in Canada and the United States, as Amazon as the leader in e-commerce, Walmart as the follower, and Costco as the primary on the brick and mortar side. So it is, in North America, a three-player race, and all these three companies are taking market share from smaller firms, from handbags to grocery and everything in between.
So that's still that great evisceration of smaller retailers going on.
Yeah. And there's one interesting story for Walmart's e-commerce success. You know, things really do come for a full circle in the market. So Amazon put out of business a company called, I believe, Pampers.com back in the 2000 era. The CEO of that company and the founder of Pampers.com actually started Jet.com, which was the e-commerce brand that Walmart bought. And that's what led to Walmart becoming successful in e-commerce way back ago, almost a decade ago now. So we're seeing, ironically, the same players really cultivating and developing the same market, which is e-commerce growth across the world.
You mentioned that Canadian Tire wouldn't be your first choice in retail. Are there any other more global retail names that have caught your attention lately, Dan?
Well, you know what's interesting, Andy? I would say there were more to start the year, but I think where I'm more interested in technology today. I think the disruption fears have been way overdone, and some of call it the Magnificent Seven stocks that I believe are a little too unjustified in their valuation. But to directly hit your question, where we are doing more work on the retail side is actually looking into those companies that are potentially going to benefit from trade down even more so. So never say never on the US dollar stores. If they can get their supply chains in order, they should also be the trickle down beneficiaries and see the same things that Walmart is seeing as well. So I'd be a little bit cautious on the middle brands, if you will, but I think the trade down beneficiaries, that might still be the place to be. But we're a little early in that research journey, so I don't want to speak too conclusively on that. But that is where we're leaning.
Dan, we better jump. Thank you very much indeed.
Thank you. Dan
Rahinton, Portfolio Manager at IA Global Asset Management. We always love hearing from Dan Rahinton of IA Financial. And, that stock it took a bit of a hiding yesterday, but it has been doing well today. We are going to hear more about that from an investor who keeps a close eye on IA Financial. That's ahead. The insurance and wealth management firm IA Financial posted fourth quarter earnings that missed estimates, and the stock slid yesterday. It has rallied a bit today. We got perspective from a guy who watches this stock closely, Denis Ricard, President and CEO of IA Financial.
Seen the stocks moving up or down the day of the announcement, so I will be patient, see over the next couple of days how the stock perform, but I think there's been an overreaction today for sure, because we've had a remarkable year last year. Yes, a miss for the last quarter, but there are a lot of very, I would say, reasonable explanation, something that are unusual, that will not be repeat itself in the future. So I feel confident about the future.
What were some of those factors, the reasonable explanation for the latest quarter, and also some factors that you just mentioned there that won't be repeated in the future? What are those?
Yeah. Interestingly, one of them is the fact that we've had such a great ride on our stock recently that there's been some additional expenses related to compensation that are related to variable to stock price, basically, like performance share units. So there was an uptick of 10 cents per share in the quarter. The other thing that what happened is that there's been a small experience loss this quarter versus a significant experience gain last year. Anyways, related to one specific group that we had. And also, I would say that the seasonality of our results have probably not been understood very well by the market. So we need to do a better job to explain that in some quarters, because of, let's say, for example, we have some auto and home insurance business, and there might be some weather issue, or whether obviously in Q1 or Q4 is because of winter. There's more claims, for example. So we need to explain a bit more the variability, the seasonality of our results.
What about the acquisition of RF Capital? How much did that impact net profits in this quarter?
Well, for this quarter, we're very pleased because it was not supposed to be accretive as fast. And so this quarter, we have a positive contribution of $3 million net for that acquisition. We've had a fantastic retention of advisors in that business. Also, the market has helped during the year. So we're very pleased where we are. And we've already started doing some synergies in that business. So, great future.
You also pulled your 17% ROE ahead of its 2027 schedule. What was the strategy behind that move?
Yeah, well, another thing that I think has been a remarkable year. Not only have we increased the EPS by 16% last year, over our 10% guidance to the market, but we've decided to advance the guidance for the ROE, which was 17% in 2027. And because we've reached last year 17.1%, we decided to obviously advance that guidance. So we believe that in 2026, we will be able to deliver that 17% plus going forward.
Expenses noticeably higher in this quarter as well. I'm wondering, what do you say to investors to reassure them about that this isn't going to be a broader trend going forward? Or is it?
Well, we manage our expenses very tightly. But like I said before, some additional expenses were really compensation related, which should be a good news. Our performance has been remarkable, like I said. In fact, over the last 2 years, our stock almost doubled. So we've had to account for additional compensation expenses related to the stock movement over that period. That's certainly the main item that we've seen in the last quarter.
You've also got $1.4 billion in deployable capital. How are you thinking about using that over the next year or so?
Yeah, we're very pleased to the fact that we've got that $1.4 billion. We have capital deployment basically is one of our main priorities, obviously for organic growth. But on top of that, we also look at growing by acquisition. We've done many over the years, 70 acquisitions since 2000. 10 of them were over $100 million. And so we're looking at acquisition, whether it's in Canada, in our current businesses, or also in the U.S., because now we've got 2 businesses in the U.S. So we're looking at a lot of opportunities. I can assure you that we will stay disciplined. And at the end of the day, if we cannot deploy it as quickly as we would like to, there's also the buyback of shares that is certainly an option that we have. In fact, we have accelerated the buyback recently because we're generating a large amount of excess capital.
Oh, you have? Okay, because I was going to ask you, given the stock's reaction today, and I know you say you're not reading into that too much, the market reaction, but I was going to ask why not accelerate the share buyback, but you're saying you've already done that?
Yeah, well, in fact, last year at some point we were at a pace of 2% a year. We've increased it in November, and certainly based on the stock price today, you would expect that we would probably accelerate the buyback of stocks in the next weeks, certainly.
Coming up, we're going to highlight some ways that you can use ETFs to track and bet on some of the hottest trends in the economy and the markets. We'll be right back with the ETF report. Time for the ETF report. Our guest says exchange-traded funds that offer a play on defense, interactive gaming, and uranium are gaining attention. We are joined by Todd Rosenbluth, head of research at Vetify. Great to see you. Of course, you're owned by the TMX Group. And just remind us what Vetify does. We know that you compile indexes, very useful for ETF companies. Broadly, how do you make money at Vetify?
You're right. So Vetify is part of the TMX Group, and we offer indices to give investors across the world the opportunity to invest in a number of different strategies: equity, fixed income, thematic products. We also have education capabilities, so we are covering the broader ETF marketplace globally to focus on what trends are in and out of favor and how advisors and investors can get exposure to those trends using ETFs.
And I think you're not recommending these ETFs that we're going to talk about, but you say they illustrate themes in the market and offer investors ways to play industries with one-stop shopping. Can we start off with Rex Drones ETF, DRNZ on the NASDAQ? What's this one all about?
Sure. So the Drones ETF, or DRNZ, offers exposure to defense investing, which has become very popular for folks given the geopolitical environment. But drones are used for not just defense areas, but drones are being used in a number of different commercial areas as well. And so this Rex Drones ETF came out late last year. It's already gathered assets. We think that defense as a thematic trend is in favor based on quality and momentum characteristics. Vetify has a thematic rotation index that we have, and defense is one of those areas that has stood out in recent months.
Right. Latest assets I have here, 51 million, but it's early days yet. And that's interesting because drones, of course, you could buy a whole bunch of different companies, but hard to know which one to grab.
Right. So you get the benefits of diversification. That's one of the things we like about thematic ETFs. It's easy, or it's easier to identify a theme that you think has legs over the next 2 to 3 years. But finding an individual company can be a challenge. So a diversified ETF like DRNZ or drones offers you exposure to that theme without having to pick an individual winner or two and then often be wrong.
I see the biggest holding there lately, Ondas Networks, a player in autonomous drones and wireless. Your next ETF that you has caught your eye, Amplify Video Game Leaders, GAMR.
That's right. So people tend to think of technology stocks as the way to get exposure to thematic strategies. And we've got artificial intelligence being one of those themes people think about. This ETF from Amplify, Gamer, or GAMR, gives an investment case to the esports and online gaming world that has been continuing to grow. We think, again, this is a diversified product to give you exposure. It has some exposure to technology companies, but not all. It's global in nature. That caught our eye. And this, again, is one of those themes that stood out from a quality and momentum characteristic. So Amplify has a strong suite of thematic ETFs. GAMR is one of those products that caught our eye within their broader lineup.
I do see, though, that as of February 19th, NVIDIA is the biggest holding at 12%, and Meta is number 2 at 11%, and then Advanced Micro. So I guess you could criticize them and say, well, that's a lot of very mainstream tech holdings in there.
Right. So these are companies that are going to be exposed to not just video gaming, but when we at an Amplify and their index partner that Vetify happens to be, when we are building an index, companies make it in for having exposure to those trends. But of course, NVIDIA is tied to other themes as well. So you want to make sure that you know what's inside the portfolio. And as we look through the broader holdings, you'll see some stocks that you probably don't own within a more well-diversified ETF.
And then finally, Sprott is well known for its actual ETFs that track uranium. Well, they actually hold I'm not sure if they're technically ETFs. They actually hold a bunch of physical uranium. But this is a slightly different thing. URNM, Sprott Uranium Miners ETF.
Right. So what we've seen is stocks that are tied to a commodity like uranium, or in fact, in this case, uranium miners, is a great way of getting exposure to that theme and that trend. but through equities. And so we've seen it is actually more popular in the U.S. towards gold and gold mining, but uranium and uranium mining. And Sprott is a leader in offering exposure to commodity-like equity strategies. And so uranium mining has done very well. There's a lot of use cases for it. It is tied. It is a tangential tie to some other broader themes like artificial intelligence. But it's an exciting time to be investing in uranium and uranium mining. And Sprott is a name many people in Canada as well as in the United States are familiar with.
Yeah, they built quite a franchise. I see Cameco, as you might expect, is a big holding here, 20%. Then Uranium Energy, US player, 12%. And then there's 11% in the Physical Uranium Trust. And then Paladin Energy and Deep Yellow. And it looks like this thing is pretty popular. Assets of more than $5 billion.
Right. So of the three ETFs that we are talking about so far today, this is the most popular product, the most established of those products. We've seen great adoption in the United States for uranium mining related ETFs, and the Sprott product is top notch.
I'm sorry, I overstated the assets there. They're north of 2.3 billion US,
well,
but
that's
still pretty big.
That's still strong.
Yeah.
I wasn't going to correct you in terms of the numbers that I'm not looking at right now, but yeah, it's a success story for Sprott. We're really excited to see this fund continue to grow assets.
Yeah, they've got quite the franchise out there. They've got a copper one, copper miners, junior copper, lithium, nickel, you name it. Thanks very much, Todd. I really appreciate it.
It's a pleasure talking with you. Thanks a lot.
Todd Rosenbluth, Head of Research at Vetify. Coming up, we're going to update you on the latest headlines. And then we'll hear from the head of Ryokan. He says that the retail landscape is better than you might think when you see headlines about high-profile retail bankruptcies. Ryokan reported a rise in profit in the fourth quarter, although revenue was lower. The Real Estate Investment Trust says it is seeing rising demand from leading retailers amid a shortage of well-located space. We got perspective from Jonathan Gitlin, President and CEO of Ryokan.
The retail landscape in Canada is very strong. A lot of the retailers that we have in this country are growing, and so there's significant demand. I'd also say at the same time, there's limited supply of good open-air necessity-based retail space, which is what Ryokan has. And so we see continued use for our space, and we feel that the retailers that we cater to are definitely in growth mode because they sell consumer goods that are necessary in really any economic backdrop, whether we're in growth mode or whether we're in a recessionary mode. People need, the common things that are needed for day-to-day life.
Okay, so you're saying any consumer spending habits that we see, whether people start spending less, that doesn't really affect your company?
That's right. We've catered our portfolio to really function well for necessity-based retailers. So grocery stores, dollar stores, gyms, things that really thrive in any kind of backdrop.
Okay, when it comes to retail space, I'm wondering if there's particular regions or segments where you see demand growing and then vice versa, where you see demand a little weaker.
Our focus has been on the major markets, big cities like Toronto, Montreal, Ottawa, Calgary, Vancouver. And the reason for this is because there's a significantly higher demographic in those markets, and that's exactly where our tenants want to be. So if you look at our average 5-kilometer radius population, it's over 270,000 people with an average household income of over $155,000. And those are the people who are obviously spending, they have the capacity to spend more, and they're spending on the exact type of product that we're offering in our centers. And so I do feel that those major markets have that demographic advantage. But that being said, Lindsay, we're seeing demand across the entire country right now. There's, I would say, a structural shortage of good retail space, and so we're actually hearing about our colleagues who own properties outside of those big six markets, and they're also in high demand. But I think that the longevity of demand is going to be more prominent in markets like the ones where Ryokan owns.
So are you not seeing much weakness then? Like I know I take your point that you said you're seeing demand across the board. So there's no areas where you're seeing weakness instead.
Not from our perspective. RioCan's portfolio currently sits at, our retail portfolio currently sits at 98.5% occupancy. Our leasing spreads this last year were at 21%, which means that tenants are paying significantly more to renew space than they were before. And there's just not a lot of supply that's been built. So I think there's a structural shortage of new retail space. So we're seeing demand across the board, keeping in mind the space that we occupy, or the space that we operate in, is really that necessity-based goods. So I'm not talking about luxury goods. I'm really talking about common day-to-day goods. And yes, I think the demand for that type of product is very strong within the Canadian landscape.
Okay. I'm wondering now if you can give us an update on the Hudson's Bay locations, that situation. Like, how long do you expect to see that affect your bottom line? And what plans do you have at this point for any of the remaining locations?
So the Hudson's Bay story is one that I would that is largely in RioCan's rear view. We've dealt with all of the space, and at this point, there's no further economic impact on RioCan. We have taken a few spaces in our portfolio and released them at rents that are far higher than what the Bay was previously paying, and so really it's just upside from here on in. But from an economic perspective, all of the impact has been addressed, and we no longer have any further exposure going forward.
Okay. In the third quarter, you had reported weakness in rent growth and occupancy in some markets for rental buildings. What's your strategy for your apartment portfolio in the year ahead?
So we're in the process of selling a lot of our RioCan Living portfolio and really focusing on our core retail portfolio. But residential, look, I think it's a great asset class. I think that there's going to be pockets of time like we're in right now where there's a bit of a saturation in that space. But I do think long term, it's a very good asset class. And I think for assets like the ones that RioCan Living had built and owned, they're new, they're on transit, they're in major markets. And so even though there was a bit of slippage operationally, we think over time that corrects itself.
I know in the last quarter, retail occupancy went up, but commercial occupancy was flat. Correct me if I'm wrong. Do you expect to see that trend continuing? Do you expect to see it improve as we move forward?
It's pretty hard to improve from 98%, but which is functionally full. But really, the retail occupancy is at 98.5%. The overall occupancy is slightly lower because we do have some office in our portfolio, which is still operating at about 90% occupancy, which is fairly strong for that asset class. Do I see that improving? The answer is yes. I think office, particularly where we own, is in demand, and we are seeing a nice momentum in that space. So we do think that the overall occupancy rate, well, it'll stabilize or increase over time.
I think we touched on this off the top, but do you have a certain segment that RioCan is going to be really focusing on for 2026?
It's really our own retail. We love retail. We're we have a very significant platform that allows us to drive a lot of growth in that portfolio. And so we're really focusing, Lindsay, on things like buying back our own shares, which is really just investing in our own portfolio. And then also building out pads and strips and smaller parts of existing shopping centers, which create a lot of value on a whole bunch of different dimensions. So we're excited about that opportunity, and we see a lot of growth coming through that. And otherwise, it's really just leaning into the strength of our portfolio and leasing at higher rates and getting better tenants in our space.
Jonathan Gitlin, President and CEO at RioCan. A couple of other stories we're bringing you from our newsroom. Canada recorded a trade deficit for 2025 of $31.3 billion, and it is the widest annual shortfall on record, excluding the pandemic. Data from StatsCan indicates that annual exports last year saw a decline. However, exports of gold, silver, and platinum jumped nearly 42%, driven by a run-up in metal prices. Meanwhile, exports to the U.S. fell 5.8%. StatsCan says that for December, U.S. goods exports to Canada were at the lowest since January of 2022. Shares in Canadian Tire higher after the retailer beat profit and revenue expectations in its latest quarter. Revenue rose more than 8%, while same-store sales saw an increase year over year. These results were driven by strong holiday demand and increased store traffic across the company's major banners. This comes after the retailer teamed up with Microsoft to develop a custom retail intelligence platform. And we're watching shares in Nutrien today. Those shares edging higher. The Canadian fertilizer giant posted profit that topped estimates, but revenue fell short. And there were shortfalls in key areas, including potash, phosphate, and nitrogen. However, Nutrien raised its dividend, approved a new share buyback program, and says it expects to stabilize the path for its phosphate business this year. Coming up, we're returning to retail, and we're going to zero in on 3 ideas in that sector. We'll have more after this. Time for Hot Picks, and we're zeroing in on the retail sector. Our guest has Crocs as his number 1 selection. He says the valuation on the shares is low, and he does see early signs of a turnaround at Hey Dude. That's a brand Crocs acquired in 2022. We're joined by Zachary Waring, equity research analyst at CFRA. Zachary, thanks very much for giving us the time.
Yeah, thanks for having me.
Just remind us, what is Hey Dude, and why was it a disappointment early on?
Yeah, so Hey Dude is another casual footwear brand that Crocs acquired. It was, originally started in Europe, and they had strong growth early on, but they pushed Hey Dude through their wholesale channels in the U.S. pretty hard in the first year or two, which created growth in that first year or two, but since has seen a significant decline. And we really think that over the last 2 or 3 years, that's kind of bottomed out. We think the first 2 quarters, you're going to see negative growth still, but I think in the second half of the year, you could see Hey Dude create revenue growth.
And broadly, you say that this company has room to grow in the States. What markets are they popular in, or what are their stronger markets?
Yeah, so Crocs is obviously very large in the U.S. and they're growing internationally, and I think they're doing that because of the tariffs in the U.S. But it's got a very low valuation. The management has been very good over the last couple of years of continuing to execute outside of Hey Dude. Obviously, Hey Dude has been the drag. You've seen the valuation go from the high teens forward PE multiple down to, it trades like a department store right now at 7 times forward earnings. So, we think valuations at rock bottom. We think they're doing a really good job of growing internationally to kind of insulate themselves from the U.S. tariffs. And we think that's kind of the growth driver moving forward.
Your next idea is Abercrombie A&F. What does this stock have going for it?
Yeah, so Abercrombie's done really well over the last 3 years. You've seen double-digit growth from the actual Abercrombie brand. They have Hollister as well as their second brand. And Abercrombie has grown significantly over the last 2 years. And, their guidance for Abercrombie has come down significantly. And that's just due to the strong growth they've had in previous years. And we think they're kind of handing the baton to Hollister, which is kind of taking the same playbook as Abercrombie. They're doing, Abercrombie's really doing a good job in marketing. They're using grassroots campaigns and social media, and they're really putting their product out there in a good way. And we think they're doing that now with the Hollister brand, and we think that's how they're going to get their next leg of growth.
And what is their target market? Are they up market, for example? Are they a little more expensive than, say, American Eagle?
They are a little more expensive than American Eagle, but they're still not the high end, right? So they still cater to, the young adult up to the millennial. And they're doing a good job of capturing that young adult as well. Obviously, their stock enjoyed a significant rally over the last 2 or 3 years, but it's come down and valuation sits at 10 times forward earnings. So, we really think the name here is a good buying opportunity. We think valuation is another one of those valuations that's kind of rock bottom. It trades almost like a department store, but you're getting much better growth and better margins.
And then finally, Deckers. What's the attraction here?
Yeah, so Deckers has obviously the high growth brand Hoka, and then UGG is their second brand. They're really focusing on those two core brands over the last year or two, and kind of gone away from their smaller brands. You know, those two brands have seen significant success, and it's one of the best growers in footwear. You know, Hoka's predicted to grow double digits this fiscal year, with UGG growing mid-single digits, which is really, really strong for the footwear industry. You know, these at the same time that Nike has seen declines and lost a lot of share recently. We think, you know, Deckers has been the beneficiary of that. And once again, this is another company that valuation is really fair at 16 times. It trades at a significant discount to Nike and some of its other peers, Adidas and On Holdings. And we just really like the valuation here for what you're getting in terms of growth.
And so Hoka and UGG are both under the Deckers umbrella.
Yes, that's correct.
And they're relatively upmarket brands?
They are. So the Hoka brand is a very expensive, you know, running shoe that's gained a lot of attraction in the U.S. and internationally. And I think that's another, you know, leg of growth for them is internationally. They're really pushing, and I think these companies are doing this to kind of insulate themselves from those U.S. tariffs. And we really think it's a great idea. Obviously, it adds to growth, but also, you know, it can help margins if you're not, you know, paying those higher tariff rates in the U.S.
It's interesting. The Hoka shoes that I've seen, they have a massive logo on the side. Apparently, customers want everyone to know that they paid up for a pair of Hokas.
Yeah, and they run upwards of $250 for their newer versions.
And then UGG, those giant winter shoes, do they sell to men as well as women?
They do. They have both. You know, they've gotten more popular in recent years with men, but their target market is still females.
And generally, what do you have to remember if you're investing in a footwear stock? What's the important thing? For example, I guess companies are more and more trying to sell directly to consumers to get information on them and pocket the margins.
Yeah, you know, I think that's kind of all the retail really wants to touch their consumer directly. You get better data, you get better customer relations, and then it can be a higher margin business, right? But you know, Nike's gone the opposite way. They were going the direct to consumer push for many years, but they've kind of leaned back into the wholesale business. Footwear typically trades at a little bit of a premium in terms of retail. They usually carry a higher multiple. And, you know, I think you're getting a discount with Deckers right now at 16 times. You know, just a year and a half ago, the company was trading at 25 to 30 times. So it's been almost cut in half in the last 18 months.
Thank you very much, Zachary. Really appreciate it. Yeah. Zachary Waring, equity research analyst at CFRA. Coming up, Canadian Airlines are slashing U.S. routes as demand plunges, with Air Transit set to end all remaining U.S. flights by June, and WestJet cutting more than a dozen American destinations. Reduced demand from Canadians flying to the U.S. has air carriers making changes. Air Transit is cancelling all flights to the States starting this spring. WestJet is eliminating some routes. CTV's Alex Carpa has more on what it means for the airlines and also your travel plans.
Yeah, this is myself with my daughter when she was going to school just outside of Pittsburgh.
Mike Gebhardt is a frequent traveler to the United States.
Well, on average, I would probably travel 3, 4, maybe 5.
His daughter lives in Alabama, but visiting her sometimes is not easy.
I do fly out of Saskatchewan most of the time, so it is a bit of a challenge. Leave early in the morning, come back late at night.
But traveling could get a little more chaotic for passengers like Gebhardt. WestJet and Air Transat recently slashed several routes from Canada to U.S. cities.
It's something to always be aware of.
Statistics Canada data last month showed that Canadians continue to take fewer trips to the U.S. in November 2025. Travel agent Daryl Silver says passengers shouldn't be worried about this shift.
Yes, could there be more problems now? I suppose, but in general, I don't think that that's significant if that is happening.
A few travel experts we spoke to say passenger demand to the U.S. from Canada is down and say it's no surprise that airlines like WestJet and Air Transat are reducing these routes.
It's one of those things where they feel they can focus on domestic, where they excel, especially on the West Coast, and become more profitable. It's good for them.
John Graddick says the reduction is consumer-driven.
Not driven by the weather, not driven by anything else. Consumers have decided that they'd rather spend their leisure travel dollars on flights other than the USA, and they're reacting to that.
Meanwhile, Porter Airlines announcing it's adding routes to the U.S., saying travelers want more options. As for Gebhardt, he says he'll continue traveling to the U.S. to see his daughter, but when it comes to vacationing south of the border, he admits he's thinking twice, especially as flight options are reduced. Alex Carpa, CTV News, Winnipeg.
Yesterday on Market Call, we were joined by Michael Hakes, Senior Portfolio Manager at Murray Wealth Group, and he covered U.S. and global stocks. And here are his top holdings, his top picks. New holdings, Thermo Fisher Scientific and Amazon.com. Today on the show, it's Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. And Greg will be taking your questions on North American equities. Well, let's check out the markets. And here's something that caught our eye today. TSX trading in record territory. And perhaps that's not a surprise. U.S. stocks slipping. Not a surprise because investors are buying into those Canadian energy names. Here is a 10-year chart for the TSX Energy Producers ETF. Now it's dominated by the likes of Suncor and Canadian Natural Resources, but it's hit its highest today, according to my screen, since 2008. And you remember oil prices briefly went well north of $100, north of $130 US, if I remember rightly, very briefly in 2008. I mean, that's pretty impressive with our energy stocks hitting their highest in well over a decade, given the oil price is really not that strong, with about $65 US. But investors just want to know that the oil stocks they're buying won't have to pour capital into the ground at a possibly unsustainable rate like those shale producers did in the US about 10 years ago. So that one surging. And Imperial Oil, IMO, climbing today. I'm almost certain that it's at record territory. Thanks, Control Room. There is a one-year chart. Baytex is in favor as well. BTE, if I remember rightly. Yeah, Baytex. They, of course, divested their U.S. assets not long ago. That stock up more than 40% in the past year. Banks that are seeing some buying today, Canadian Imperial Bank of Commerce. It is hitting a record high, according to my screen, up more than 50% in the past year. So despite worries about our economy amid this trade war, investors buying into that particular lender. Here are some movers south of the border. Deere shares up more than 10% after the company raised its profit forecast. It seems that farmers are spending again. And Herbalife is up more than 17% after Ronaldo, the soccer giant, God, invested in the wellness platform. All of my investment advice I take from soccer players. Ava's budget under pressure. You can see that stock down. Car is the symbol. It looks like the car rental business not doing that well. The stock pretty flat over the past year, but sliding 21% today. And apparently debt investors are watching the cash burn at this company, bondholders. So that may be the leverage of the company. Yeah, they're well into junk territory, a BB rating. Okay, are we out of time? Let's have a very quick look at gold. Do we have time? Gold trading above 5,000. We have such a fleeting moment together. I think we're out of time. There's gold. Thanks, Control Room. Okay, going to hand you over to the one and only Roger Peterson with Morning Markets after this.